Welcome to the Money Talk Show TV, baby. I am your host with the most, baby. I am the motivated, baby. I am the educated, baby. I am the options trader, baby. I am the money coach, baby. Okay. And today I am going to be talking about what is a strike price, baby. Okay. In a call option. In a call option, baby. Okay, everybody want to know about the strike price, you know what I'm saying, and what's going on and everything. Okay, and this video came by a question that was by a member in the group, baby. Okay, so let's get into it. Bam. Okay, and the member of the group is, all right, and the question is, she asks, I'm about to purchase my first option just to test the waters and see how it turns out. I'm going to rock with you fellas and go with y'all on a call for May 21st with BNGO, baby, okay? So I need to know if the dollar amount we select is what we determine the stock ending price for the day or beginning. That was a good question, okay? Now, the answer to that question is it depends on the investor, okay? And it doesn't matter if it's at the end of the day or the beginning of the day, because when really that option is going to lose value if you wait to the last day, okay? If you are in the money, that option could lose value unless the stock goes straight up the last day. But other than that, you lose a chance of losing a lot of value out of your contract if you wait to the last day, okay? All right. Now, you asking yourself, what is a strike price, baby? Okay. A strike price is a set price at which a options contract can be bought or sold when it is exercised. For call options, the strike price is where the security can be bought by the options holder. Okay. Buying a call option, you want to call before you want the call to come in the money, but you don't have to wait till it gets into the money to sell your contract, okay? All right. Now, let's move on to an example about the bingo, baby. All right, with the bingo. Okay. All right, excuse me. Let me get myself together. All right, now that we're here at the bingo. All right, let's go to the bingo. Okay, the question was about a call option on May 21st, so we're going to go ahead and do that, you know what I'm saying, to get a good example. Okay. So right here, if you are looking at what I'm using and looking at right here is Robinhood for the desktop. Okay. Now you go to see we got Bingo, baby, BNGO, Bionano Genomics. Okay. Now you will go right here to the trade options. Hit that trade options button, baby. Okay. Now right here, you want to make sure you want to call. Okay. And make sure in the buy section first. Go in order. You want to buy it. You want to make sure it's a call. Then you want to check your expiration date, baby. Check that expiration date, okay? Now, once you check that expiration date, we was talking about May 21st. Okay, so now we're gonna use May 21st as the example. Okay, now right here, this big red little button, little circle right here lets you know what is the price for the stock right now. This is real time, baby. Stock price is 721 at the time I'm recording this thing. Okay, stock market still going on, baby. Still going strong and long. Holding. All right, get back to it. Now we're back to the strike price. Okay, these are your strike price: $3, $4, $5, $6, $7, $8, and so on. Okay. Oops, excuse me. And if you notice, they go all the way up to 15, all the way down to the $1. Okay. Now the question was on May 21st. Depend on what strike price you pick. Do if it's to be in the money or whatever on that day, the beginning or the end? That's kind of slim, not a much of a difference beginning to end, unless the stock shoots up very high that last day. But if you wait to the last day, don't wait to the last day. Don't wait till the last day. Say, yo, I call options. Unless you just high in the money and the stock is just continuously going up. But other than that, you lose value in your stock when you hold it to the last day. All right. Now, just give it an example. Right here, say if I pick the $8 strike price right here. I'm going to pick this $8 strike price, for example, right now. It is $77 if I want to buy this right now, okay? So, boom, you click that. You see right there, that's the strike price for May 21st. And we're taking in the $8 strike price because it's right above, right a little bit below 7. So that means that I bet that BNGO will go past or increase in value from 721 really past $8. I want it to go past $8 from buying an $8 contract. You want it to go past. When it goes past, you are in the money. Okay. And when you're in the money, these, you notice the price difference right here. All right. These are low. Only you got to go up to $1, $7. You got $1. You know what I'm saying? Right up here. So, you know, let's get down here. These are in the money. You see up under here? These are in the money because it's okay. Yeah, these are in the money. You got $7, 6, and so on, but you got 115, 100, 200, 300, 400, 5, 6 that go on. Okay. So if you get to the May 21st and your strike price is $8 and the price is above that $8, it's on when you want to sell it. You really want to sell your call option when it's up. Okay. And give you an example. You want to sell when it's up here at the high peak. It's not so much at the beginning of the day or the end of the day, because you see how they change. And if you'd have waited to the end of the day, you know, you'd have went down, you'd lost some value. So usually contracts are sold at the beginning of the day and bought at the end of the day. That's most of them, a lot of them. Okay, that's the trend. Because they like to buy at the beginning, sell when it's down low, because they think that this stock's going to go up next week. So they want to get it at a low price versus buying it at the beginning of the day. I like to let stocks go see what they do, let them fill out. Okay, but I'll give you some tips to help you out. Okay, the first tip is, I ain't even put this back on there. Lost the tips. Okay. All right. The first tip is know your risk. Options trading is very risky, baby. Okay. Options trading is very risky. You do not want to be sitting there spending your money, that hard earned rent money, light bill money, gas money, baby mama money, baby daddy money. Okay, you don't want to get hurt. Okay, you don't want to keep real. You don't want to get hurt. Okay, so it's risky. It can go up and down. You can go spending $77. That thing can go up to $300-400 by next week, and then it can drop down to $50 the week after. It changes. It depends on catalyst and news. That's the second tip. Okay, catalyst and news affects the price very much. Okay, so you can get some good catalyst that day or that week, and the stock can shoot up to the moon, towards the moon. You know what I'm saying? And or it could be the opposite. You can get some bad catalyst, a bad, news article, and that thing gonna drop straight down. So therefore, you'll be left in the dust, and your contract will be worthless. Okay, you don't want to, hold on to a worthless contract. All right. And the third tip, baby. Okay, third tip is, look at your price average, the 10, the 20, the 30-day moving average, okay? Look at that, and that gives you an average of where that price for that stock was at and where it's moving at. You don't want to just be sitting there buying a stock and thinking it's going to put in the strike price, for example. Go back to the example. You don't want to be buying no $16 strike price somewhere up in here just because it's cheap, just because it's $2. I have done it. Sometimes I still do it, okay? But I be doing it for a special reason, you know what I'm saying? I buy a whole bunch of it too and try to buy it, flip it, set it for 6, 7, 10, somewhere around here. you know, but it's a whole nother ball game. But right now, strike price, you don't want to be buying these way up here, because the reason why is, that's why I talked about the 10, 20, and 30-day moving average, baby. Okay, look at your charts. All right, look at the week. What's been going on for the week? It's been at $8. Drop down a little bit now. The hardcore drop right here. That's why I think it's gonna be a good price, I think. All right. Then you got the monthly chart, where it's been at $8, $9. It's about the most, $9.60. It didn't go nowhere past 10. You only got 3 months, okay? 11. The most it went was $15 around February the 16th. Okay, you look at it a year. All right, so you know what it is. February 16th, $15. That was to the moon. From here, 5.50 to $17 within a month or 2 months. Yeah, that was to the moon. Okay, so that was the right price right in here, baby. Okay, but we believe it's gonna hit back somewhere around in there, but ain't no telling it's gonna hit back in there by May 21st. So therefore, the strike price is very important when dealing with call options. Okay, all right, but that's the end of the video. All right, got some links below for Webull, Robinhood. Go ahead and download download the links, and remember to hit that website, Money Talk Show TV, moneytalkshowtv.com, baby. Ain't .com, but you put .com behind it. Go hit that. You got some news articles, some blogs that your boy be blogging on. You know, get my stuff together. All right. But this is your strike price video intro. And remember, be blessed to invest in yourself and get that money in the stock market, baby. We out. Said we out. Still having a little technical difficulties. Now, one more time. I said we out. Thank you for watching my videos. Please, if you like the content, hit the like button, subscribe, and you go ahead and check on any of the other videos that we got over here or here. Be blessed to invest in yourself.